hopefully. Okay, and I'm going to leave it like that, okay? It's not full screen, but if I make it full screen, it's going to cut the left off. And so I'm going to leave it like this so you guys can see all of it, okay? And what I'm going to do is I'm going to go through this little lecture with you that I put together. It covers almost all of the terminology in chapter 3, and the terminology is what's hard to understand. So I'm going to go through this with you. If you want to follow along in the chapter, I'm using the definitions and things from the chapter. Like I said, for some reason I went through the chapter last semester. We spent 2 days going through this, and they had a hard time tying the terminology to the pictures that, on the forms and stuff. And so I put them together in a PowerPoint presentation so you can see the terms and what they look like together, okay? And so, like I said, I'm just going to go through this with you real quickly, and then we're going to go ahead and start looking at chapter 3, okay? The first thing we're going to be talking about is analyzing transactions. I told you that's the most important part of the accountant's job, is analyzing the transactions. We have to know what's going on in the business, right? I told you it's called accounting because we have to account for things, right? We have to know where things went, where they came from, what's happening with them, where they are, all of those things. In chapter 2, we learned about accounts, right? We started looking at accounts. And so this time we're going to look at, all you got to do, if you look here at the picture that I gave you, this is a T account right here at the top. That's all there is to it. Now, they can get bigger than that. Your cash account may cover a whole page, right? But it's just basically a big capital T. And at the top of that T, it has the account name. Okay? Remember, we talked about account names are different from types of accounts, right? So you'll never see a T account, except for just an example, that says asset, right? It will say cash, accounts receivable, equipment, machinery, okay? You'll never see one that says revenue, except maybe as an example. It will say fees income or fees earned or something like that, right? So the name of the account will go at the top of the T accounts, okay? The left-hand side of that T account is called a debit, and the right-hand side of the account is called a credit, okay? It doesn't matter what account it is, what kind of account, anything. The left is always a debit, the right is always a credit, okay? So they use abbreviations in some of the forms. The debit is abbreviated DR on most accounting forms. It's Latin. The debit, it's actually debit something else. I forget what the other word is, but it's a Latin term. Accounting goes back to the Roman Empire. There was actually a guy who wrote an accounting textbook back, like before they came over to America. And he used a Latin because he was in Rome. And so it's actually debitus something. So, but the abbreviation that they use on the forms is DR. And then on the right-hand side, sometimes you'll see CR, okay? And that's just debit and credit.
Is that in capital letters or?
Either way. Sometimes they put a capital D and a small r, and sometimes they do it all caps. But it's just debit and credit, okay? All right, let me go on down to the next one here. That's just the title slide. Okay? Before we can do all of this, the first thing we have to know is what an account is. And we looked at this in chapter 2 a little bit. It says accounts are separate records set up by business to chronicle financial information. Okay, chronicle just means that it's based on time, right? So if you're looking at a business records, right, like they're ledgers or their journals, they're always done in order by date. So it's a chronological order. If you look in your textbook, a lot of times they call it a diary, right? Remember, in a diary, like you write something every day or every couple of days, and so it's chronological, right? Okay, so the accounts are set up so that we can do that. We can chronologically keep track of the account. Those of you that have a checking account know this is very important, right? If I write a check on Friday and my payment, my paycheck doesn't go in the bank until Monday, that's chronologically going to get me in trouble, right? Okay, I'm going to get that insufficient funds notice, and they're going to charge me 25 or 30 bucks, and it's just, I had the money there, but it wasn't there on the day that they paid the check, right? So chronological is very important. It's important that we have the times down and we know when things happen, right? Okay, accounts represent the property and financial interest of the business. So that goes back to our accounting equation, right? Remember the accounting equation, the left-hand side is the property, the right-hand side is the financial interest, right? So we've already talked about that, nothing new there, okay? Talks about the amount and types of property we own, how much we owe, and how much interest or equity the owner has, right? So that's straight out of chapter 1, chapter 2, nothing new there. Use of accounts helps the business analyze, record, classify, summarize, and report financial information. If you remember back the very first day we started talking about this, I went through that list and we talked about what every one of those terms means, right? You guys remember that? We talked about what it means to analyze, record, classify, summarize, because each one of those activities is very important. You need to know what they are and how to do those, right? That's why we're going through the accounting cycle, so you'll understand how to do those things. We're working on analyzing, recording, and classifying right now, right? That's what we're working on. We also did some reports in chapter 2. We did financial statements, and so we've already covered a lot of this cycle, okay? Right off the get-go. We jumped right into the middle of this thing, didn't we? Okay? All right. What does it mean to classify accounts? Okay? We've talked about this before. Classification is organization, right? It just means that we're organizing things into groups. Okay? And we already know we have assets, we have liabilities, and we have owner's equity. If you did your chapter 2 discussion questions, you defined all of those for me, right? That was on your discussion questions, what each one of those means. Okay? So we're organizing our accounts into groups, right? Okay? There's also a couple of other groups that we've looked at. We looked at revenue and we looked at expenses, right? Those fall under owner's equity, so they don't break them out all the time. But those are also types of accounts, right? Each account has a name. Okay? That name needs to be descriptive so that I can figure out what it means, right? Cash tells me that's money, right? Accounts receivable means that I need to receive money for that, right? Accounts payable means that I need to pay money for that. And so the account names are very important. That's why I told you it might help you to make a list, right, of all the asset accounts that we see, all the expense accounts, maybe the, maybe different types of revenue account names that we see, so that you'll get comfortable with that and understand what they're telling you, right? Most of the time you can tell by the account name what category it's in. Especially expenses, right? Because they always have the word expense at the end. So that makes it really nice. Okay? And it says classification is illustrated by the accounting equation. If you look on the accounting equation forms that I gave you, up at the top it has property, financial interest. And then below that it's broken down into assets, liabilities, owner's equity, right? You can see, looking at that accounting equation, how they're classified. It's pretty, it's not obvious, but it works itself out, right? Okay? If it was obvious, we would have understood it the first time. Okay? I'm not going to act like this is easy. I know it's not easy. I had to take accounting 1 and 2 when I didn't know anything about accounting about 150 years ago. Okay? All right. The next slide just talks about the accounting equation. Okay? And I gave you a little picture here. The accounting equation is assets equals liabilities plus owner's equity, right? A equals L plus E. Okay? On the right-hand side, I gave you another little picture because we need to talk about a couple of things here. Okay? The T accounts work differently depending on which type of account it is. And we're going to talk about this, and it's in the packet that I gave you. Remember the little hand packet that I gave you that has the picture of the hand on the front? That information is going along with this that we're talking about now, okay? When you look at your accounting equation, what they want you to see is that there is a difference there, right? This picture did a really good job of illustrating that. They actually drew this little green line in between your assets and your claims, right? Your financial interest on the right. The reason that's there is because the T accounts work differently depending on what type of account it is, okay? So if you look over on the left, it says your assets increase, right, on the debit side, and they decrease on the credit side. So what that means is if I made a deposit into my checking account, I would do a debit on assets, right? So if the owner invests $30,000, I'm going to go on my assets T account and I'm going to put $30,000 on the left-hand side because that's the increasing side, right? If I write a check for $10,000 to pay salaries, I'm going to look on here, the credit side goes down, right? That's my decrease. So I'm going to record that $10,000 on the right-hand side. Okay? So increase I'm going to put on the left, decrease I'm going to put on the right. When you do your T accounts, especially like in your packets, I gave you some T accounts that you can work on. A lot of people, it helps them on the asset accounts to put a little plus up on the left-hand side and a little minus symbol over on the right-hand side. If that helps you to remember, that doesn't hurt anything. Okay? After you do it a few times, you won't need that anymore. But for instance, in your packet, the very first page, I have a list of T accounts there for you. On the assets, every one of those, you can put a plus on the left and a minus on the right because assets are all the same. It doesn't matter what kind of asset it is. It's going to increase on the left and decrease on the right. Okay? If you look over here on the other side, you'll see that that's backwards, right? Does everybody see that? On the liabilities and on equity, the left-hand side decreases the account and the right-hand side increases the account. Okay? And I'm going to show you why this is that way. I told you it's all to make the math work, right? Okay? There's a rule that we're going to learn in chapter 3. Remember we talked about double entry accounting? That you always have to have 2 accounts, right? You also, every transaction has to have one debit. Well, I'm sorry, at least one debit and at least one credit. So this is another rule to help us check our work, right? So I know I have to have 2 accounts, or at least 2 accounts, right? And now I know I have to have at least one debit and at least one credit. So if I do that $30,000 owner investment that we were talking about a while ago, and I put $30,000 debit under assets, Then over on the right-hand side, I would have to do a $30,000 credit under equity. Okay? And that means that I'm increasing my cash account and I'm increasing my equity account, right? So this is all mathematical, right? But if you follow the rules, we're going to go over those. Like I said, you have to have at least 2 accounts, and you have to have at least 1 debit and at least 1 credit. So when you look at this, if I debit assets, I have to credit something else, okay? And if I'm increasing both sides, obviously equity is going to go up along with my cash, right? And so it's all mathematical, and they've done the T accounts to make it where it works, okay? So if you look at liabilities, okay, we talked about accounts payable. We talked about maybe notes payable or mortgages payable, right? Any of those liability accounts are going to decrease on the left and increase on the right. It doesn't matter what the name of the account is. If it's a liability, it's going to be the same, okay? On your equity, the only equity account really that we look at is your capital account and your drawing account. And the drawing account is not the same as this, so that's why it's not on here, okay? So on your equity, this would be your actual capital account, okay? All right? Does everybody see why they go up and down differently? The left-hand side, I'm increasing on the left. The right-hand side, I'm increasing on the right. And if that helps you to remember that, that's good, okay? For these accounts, okay? So we're talking about assets, liabilities, and basically your capital account, right? Okay? All right. A little bit of review. Said we learned in chapter 2 that the accounting process starts with the analysis of business transactions, right? I even gave you the page numbers so you can go back and look at that if you want to. Okay? So we know that. We've worked hard on that the last, 3 weeks, right? Making sure we analyzed the transactions. The T accounts are going to help us do that, okay? We used these steps to analyze the effect of a transaction. Step 1, describe the financial event, right? And we went through that almost every day. You know, we have to figure out what the property is, what we got, who owns the property, right? And how much we're going to increase or decrease, okay? Then the second step was to make sure the equation balances, right? Okay, so you go back to the rules I was giving you. This is the 3rd rule, okay? So in chapter 3, we're going to do these 3 rules. The first one was you have to have at least you have to have 2 accounts, right? At least 2 accounts. The second rule is you have to have at least 1 debit and at least 1 credit. And now we've got the 3rd rule, which says they have to balance, right? Right? If we're going to debit for $30,000, we have to credit for $30,000. Okay? So that's basically the only rules you have to follow. I didn't say they were easy rules. I just said they were the only rules. Okay. Okay? So that's what we did in chapter 2. Now we're going to go on to chapter 3, and we'll look at how we're going to do it in chapter 3, okay? All right. It says, what is a T account? Okay, a T account is a T, all right? It looks like the letter T. It has the name of the account on the top, and then it has columns for debits and credits. And it says accountants use T accounts to analyze transactions. Now, if you look over on the right-hand side, I gave you a picture, okay? Okay. If you look on page 69 in your textbook, okay? Page 69, if you've got a sticky note, this is a good page to mark, okay? Page 69 has basically the same drawing that I have up here for you, Okay?
We can't hear you. We lost you. Hello?
I'm not even talking.
Hello? Oh, man, it's so not a good time. Oh, great. Oh, crap.
I have no 69.
Oh, yeah, this is so not good. Oh, my gosh.
I think we lost connection.
Hello?
Okay.
Say 69. They're
Oh,
in the
68.
I'm starting to panic.
But tells him whenever
Okay.
that's
the same thing that's up there.
No,
I can hear you.
Oh,
Page 69, figure 3.4 up at the top of the page.
69.
don't look the same.
No, it's not exactly the same, but it's close.
Yeah, that's pretty close.
This is the picture that they based this graphic on. I found the graphic online. So, okay. What this does is it shows you graphically, right, in a picture, the differences between the types of accounts. All right. So, the top line of my graphic there and also in the book is exactly the same as this picture, right? So your assets increase on the left, they decrease on the right. Your liabilities decrease on the left, increase on the right. And then your capital account, which is what they show on page 69, your capital account decreases on the left and increases on the right. Okay? So those are the same as what I showed you a while ago. Okay? So that's those three across the top. And then on the bottom, the book shows your drawing account. Okay? Your drawing account increases on the left. Does everybody see that in your book on page 69? It's not on my graphic, so that's why I'm pointing it out. On your drawing account, the debit increases. Okay? The reason it does that is because your drawing account is against the capital account. Right? If I take money out, I'm taking money out of my capital account, right? So they have to be separate so that they have to be backwards so that when I increase drawing, it's decreasing capital, right? Okay? Right. So when you look at these, you'll see the drawing account is backwards. They call that a contra account. C-O-N-T-R-A. That term is in your book somewhere. I can't remember where it's at. It's called contra. And contra just means against, right? So it's contraindicative, right? It means it's against that. If we were in South America, they battled the Contras a lot, right? Does anybody remember that? That was a group. I don't remember which country it was in. I think it was in El Salvador or Ecuador or one of those countries. They always had them in the news. They were called the Contras, and it just meant they were against the government, right? That's where they got the name from. But your drawing account is a contra account. It takes away from your capital, and so that's why it's backwards on there. Okay. Your revenue account increases on the left, or I'm sorry, yeah, I'm doing the decreases on the left and increases on the right. So if you look there on page 69, your revenue account decreases on the left, increases on the right. Okay? Now, I'm going to give you an example why it's like this. I told you it's all math, right? Okay? If I sell $5,000 worth of stuff for cash, okay? I'm going to increase cash, which is a debit, right? It's on the left. And I want to increase revenue, right? We've talked about this, which is on the right. So I'm going to do a debit and a credit, right? That's why they're different, is so that the math works, okay? And so I can do a debit and a credit. This system was set up just to check ourselves. That's why they've got it set up this way, so I can check it. I know I have to have two accounts. I have to have a debit and a credit, and they have to balance one another. So if I follow those rules, it gives me 3 ways to check my work for everything I do, right? So, I mean, and that's what accounting is about. We talked about auditing and all of that. The main drive in all of this is being able to check our work and make sure that we've done all the steps, right? Okay? And then the last one that they talk about is an expense account. Okay? Expense accounts are also contra accounts, right? What happens to my equity, my capital, when I have an expense? My equity goes down, right? Because I'm taking money away from my equity to pay that expense. So remember when we did our income statement, right? If we lost money on our income statement, on our statement of owner's equity, that pulled our capital account down, didn't it? We had 1 or 2 like that in the homework that we did, where we had a net loss, and that caused our equity, our capital account, to go down. And so that's why your expense accounts are increased on the left and decreased on the right. Okay? Now, I'll give you an example of this one. I paid $10,000 in salaries a while ago. Remember us talking about that? We did a credit to cash because it decreases our cash account. Okay? The other entry for that analysis has to be a debit. Right? If I credited cash, my other entry has to be a debit. So if I look at my expenses increase on the left. So I would credit cash for $10,000 to pay that salary, and then I would debit expenses for $10,000, which increases the expenses, right? So that's, like I said, it's all just math. It's all set up so that those 3 rules help us look at every transaction. Okay? And page 69, if you get confused over what an account does, that's the picture to go look at, because it shows you every type of account we're going to be working on. Okay? I don't care if you have 37 assets, they're all going to look the same on the T accounts. Okay? If you notice in your packet, I tried to group the different types of accounts together when I made the T accounts myself. Some of the ones that they did, they didn't do that. They just gave you the T accounts. But the ones that I made myself, I grouped all the assets together. I put the capital accounts together. And the reason I did that is so, if I go down that list of asset accounts and I'm doing my T accounts, they're all the same, right? I have a plus on the left and a minus sign on the right. They all look exactly the same. It's just a different account name. Okay? And so, like I said, it doesn't really matter what the name of the account is. It's what type of account it is. Okay? And like I said, that little graphic on page 69, those are the 6 types of accounts we're going to be using all the way through this class. Okay? And so those 6 types of accounts, you need to memorize what the T accounts look like. Okay? If you can't memorize it, take a picture of that and post it on your forehead. No, I'm just kidding. Put a sticker in your book so you can find it, okay? That's why you paid, what, $200 for this book, right? Okay? Page 69, mark that page. Once you do this for a while, you'll get comfortable and you won't have to refer back to that. But it'll help you get started, okay? All right.
69.
Yeah. Okay? All right. So, we reviewed what we did in chapter 2. Now we're going to look at how we're going to do chapter 3. we're going to use T accounts, okay? And it says use these steps to analyze the effects of the business transactions. So now we have added a little bit to it, okay? We're still going to do step 1, analyze the event, right? Exactly the same as what we were doing. We're going to figure out what's affected, classify the accounts, determine how much it's going to increase and how much it's going to decrease, right? Number 2, we're going to apply the debit credit rules for each account affected. Okay? So we're going to look at, is it left or right? Are we increasing on the left or decreasing on the left, right? We got to figure out those rules. And then we're going to make an entry in the T account form. Okay? When you're using your T accounts, if you look on the bottom of page 69, you can see they have put little letters next to the entries. Can you guys see that? On the bottom of page 69, they've got like little letters in parentheses. The reason they do that is so you can go back. If you have a mistake, you look at the letter A, right? That would be your first transaction. And you make sure that there are 2 A's, right? Because there has to be 2 accounts. So you should have the letter A twice, right? Okay? The next thing is, both of those A's, one of them should be a debit and one of them should be a credit. So if you have 2 debits, if the letter A is on the left-hand side both times, that helps you find your mistake, right? The other rule is they have to balance. So if letter A is $10,000 and the other letter A is $11,000, that's not going to work, right? So using these T accounts, it's real easy to go back and trace your work. They have you label your transactions. So you should have 2 A's, 2 B's, 2 C's, right? One of them should be on the left, one of them should be on the right, and they have to be the same amount of money. And so that helps you to go back and look at it. If you make a mistake, it helps you find them, okay? That's the purpose of this. That's why they have you label them as you're working on them, okay? All right. So, the rules of debit and credit. We talked about this. It just means left and right. Online, some of the sites I found actually called it the rules of left and right. And it means the same thing, right? Debit is left, credit is right, okay? Debits are always the left side of the T account. Every business transaction must have at least one debit. Okay? And it says debits increase the balances of your assets, expenses, and drawing accounts. Okay? All right? Credits are always the right side of the T account. Every business transaction must have at least one credit. Okay? And credits increase the balances of your liabilities, owner's equity, and your revenue accounts. Right? Okay? So those are the rules that you have to follow when you're looking at your transactions. Okay? You have to have what? You have to have at least 2 transactions. You have to have a debit and a credit, and they have to balance one another. Okay? Those are your rules that we're working with. Okay? The reason this is important, how many of you have done math? Everybody, we've all done a little bit of math, right? Remember there are rules in math, right? And we have to know what the rules are in order to get the right answers. Okay? For instance, in Excel, in my head, if you told me 1 plus 1 plus 1 divided by 3, I would know the answer. That's an average, right? 1 plus 1 plus 1 divided by 3 would be 1. If I put that same formula in Excel, I would get 2 1/3. Okay? Because Excel has a set of rules it has to follow right? It's called the mathematical operations, and the rules say they have to do the division first. So they would take 1 divided by 3 is a third, and then they would do the addition, so you would get 1 plus 1 plus 1/3, right? So it would be 2 1/3. And so that's the same thing with accounting. We have to know the rules so we get the right answers, right? And that's what they're going over here with you, is to make sure you do the math the right way. Okay? Let me find, I want to find one here that has a picture that I like. Okay. Look on page 61 in your textbook. Okay? You can make yourself a note. We are on, which slide is this? This is slide 9. It goes along with page 61, okay? Page 61 has a picture at the top that shows the different types of accounts with balances. Okay? Balances are important because I have to know the balances before I can do the statements, right? Okay? And it says after analyzing the business transactions, we need to compute the balance for each account. Now, what you need to do is you need to add all of the debits. Okay? And you'll put a little line. If you look at equipment, they're on page 61. You'll see they had debits. They put a little line under it, and then they totaled it, right? So they had 5,000, and then they had 6,000 added to equipment, and that gave them a balance of $11,000. Okay? When you add one side of the column, that's called a footing. Okay? And they have that term in the book. Basically, it's a subtotal, right? So you're going to add all the debits for that T account, and then you're going to add all the credits for that T account and do a footing on that side. And then to get the balance, you take the biggest number minus the smallest number and record that on whichever side is bigger. Okay? So if you're an asset account, look on cash on page 61. They had $100,000 put in on the left, and then they had all of those transactions on the right that added up to 17,000, right? So they've got 100,000 on the left, 17,000 on the right, and then you just subtract and you put the balance on the side that has the biggest total, okay? So they put $83,000 on the left, okay? Does everybody see that? They're just totaling both sides and then figuring out what the balance is, okay? Now, they throw another term at you, okay? The other term is the normal balance, okay? The normal balance is the side you would think the balance should be on, right? For the accounts we're going to use, the normal balance is always the side that increases. Okay? Example, cash. If I got a negative number, which would mean that my balance was on the credit side, that would mean that my bank account was in the hole, right? That's not normal, right? Normally, if I'm a business, I want my balance to be on the debit side because that means I have money, right? So that's why it's called the normal balance, the side that I normally would expect to see the balance on. And like I said, for the accounts we're going to do, it should always be on the increase side, okay? So that means that some of them are going to be on the left and some of them are going to be on the right, okay? That little packet that I gave you that has the hand on the front, if you flip back to the second page, it gives you two hand symbols, gives you the Texas Longhorns, and the number 3, right? And if you look at that, it's just a general way of helping you remember which ones have a normal debit balance and which ones have a normal credit balance. There's also a video of a young lady who demonstrates all of this. She actually does the hand symbols and shows you. It's posted in my Ozarka under activities. There's a video you can watch of her going through this and explaining the debits and credits and the normal balances, okay? So, but that little picture there that I gave you in your packet does a good job of that. Okay? All right? And here's a picture of that. This is what's in the handout, so I gave it to you. You can see it a little better in the handout. Okay? Your normal balances, debits are assets, expenses, and drawing accounts. Your normal credit balances are liabilities, owner's equity, and revenue. Okay? And if you look on the front page, you can see I gave you the fingers. Assets, expenses, and drawing are on the outside. That's why it does the Texas Longhorn, right? And then liabilities, equity, and revenue are in the middle, and that's why they do the 3 middle fingers. And if you just use that a couple of times, that'll help you remember which accounts, have a debit balance and which ones should have a credit balance. Just a little graphical illustration to help you remember that, okay? Like I said, when you're doing your T accounts, if you'll write plus and minus, and then minus and plus on the right ones a few times, you'll have that down pat, okay? It only takes a few times of doing that. The other thing is, if you make a couple of mistakes and have to find them, you'll figure that out really quick, okay? Because you get tired of having to find them, all right? Okay? As I talked about, we use the double entry accounting system. I have a reference in there to a crossword puzzle that I didn't make you guys do, so don't worry about that. Okay. After you do your T accounts and you get all of your balances, then we're going to do what's called a trial balance. Okay. And the trial balance, see if I can find a picture of that for you. They show a picture of that on page 70. Okay. The trial balance is just a list of all of the accounts. Okay. And the important thing is your debits have to equal your credits, right? This trial balance doesn't mean anything. It's just a tool to make sure that your debits and credits are equal. Okay. So once you get all your T accounts done and you do your balances, you put them into this trial balance form, and all it does is it makes sure that your debits and credits are equal. Okay? The other thing it makes sure is that you learn which ones are debits and which ones are credits for the normal balances, right? Because if you don't put them in the right column, they're not going to balance, okay? So that's another tool to help you learn that. Okay. The last part of chapter 3 talks about the chart of accounts. They show you an example on page 73 of a chart of accounts. I told you the last couple of classes, when we get into chapter 4, they give us the account numbers for all of the accounts we're going to use. And it makes it a little easier because I know if they're ones, they're assets. If they're twos, they're liabilities. If they're threes, they're owner equity. If they're fours, they're revenue. And if they're fives, they're expenses, right? And so that makes it a little easier. Once we get to chapter 4, they give us the account numbers. And you can work with those, and it makes it a little easier. The reason they give you this information right now, your chart or your trial balance and all of our statements from now on will be in order by the chart of accounts. So when you list your accounts on these forms, they always go in the order that they're in the chart of accounts. And so when we get to chapter 4, that'll be a little easier to do. Okay? And I give you a little bit on that. I give you a little bit on the account numbers. Okay? And so that's pretty much all that we need to talk about right now. Next time, we'll go ahead and start looking at some of the math, and we'll do some T accounts, okay? So I'll get you started on that. Just go ahead and finish up your Chapter 2 homework. Get all of that, make sure you get it all finished up and everything. And so I can get that from you. And like I said, next time we will start working on putting some numbers into paper. So make sure you print out your forms and bring that with you for next class, okay? All right. Good deal.